Welcome back to Rich Dad StockCast. I'm your host, Denney, and today we're talking about something every investor experiences at some point, and that's mistakes. And the truth is, nobody becomes a great investor without making a few bad decisions along the way. But what separates successful investors from struggling ones is simple. They learn from mistakes faster, and they avoid the big ones that destroy wealth. And today, Rich Dad expert Andy Tanner is joining me to break down the biggest investing mistakes people make, and more importantly, how to avoid them. And before we dive in, go to stockcastbonus.com. Grab your free investing tools. If you want to invest smarter and avoid costly mistakes, that's where you start. Andy, welcome back.
Great to be with you, Del. When you told me this was going to be the topic, I thought, well, there's no shortage of personal experience material here to draw from, but I'll also try to also include some mistakes I see generally in my travels of other people as well. But just my own mistakes, we could fill a few hard drives of video with that for sure.
There we go. A few terabytes of data there.
A few terabytes, yeah.
Now, luckily with mistakes comes education and learning, and I'm sure we'll talk about that as we go. But speaking of learning, stockcastbonus.com, there's great education there, great resources there, and it's free. But what's in there? Let me ask you that.
Hey, speaking of mistakes, it'd be a big mistake to miss that because there's no charge for the things we put on there. They're free things. Every podcast, I point people to that simply because I know the balance of content we listen to as opposed to the action we take. Well, that's a mistake that people could fix. So yeah, there's great resources there. We change it up from time to time. Right now, we got a great ebook. It's free. Download it, read it, and it'll help you do things, not just learn things. Got to learn and do.
Indeed. Thank you for that. Now, let's start with the big and obvious question. What are the biggest investing mistakes you see people making over and over and over again that just makes you want to bash your head against the wall? Let's start there.
Well, I don't know if it wants to make me bash my head against the wall, but I think you brought up a really important point early that they're going to happen. So let's begin with that. I think one of the things Robert Kiyosaki said, and I don't want to butcher his quote, but he'll say things like, don't waste a great mistake, man. Don't waste it. Because those are incredible learning opportunities. And perhaps, we might frame this in, should we try to avoid mistakes? Yes, but we shouldn't necessarily fear them. And there's a difference. There's avoiding a mistake, and then there's being terrified to make one. And I think the second thing is, it's not helpful. Every mistake is a lesson. So we might start there is don't waste them because there is rich lessons. And some of them are expensive lessons, but, none of them really take your life in finance. You can do a lot of dumb things in the world and, you go base jump or whatever, but nothing you ever do in the world of finance is life threatening. And so if your amygdala is lighting up and you have fear of that, just realize that, hey, there's no financial mistake that you can't recover from. And so be bold, have fun, but learn from the mistakes. So with that, let me share a few that just come to mind randomly. And the viewers should know, or the listeners should know, that I don't ever ask Del to send me things in advance because I like the spontaneity of the podcast, so it's fun, simple, and it's real. So the first one that comes to mind is how can I say this the right way? The first one that comes to mind is when we don't have an appreciation for the knowledge required to do certain things. So for example, someone decides in the year 1998, where the dot-com bubble is building, that they're going to go out and try this, and everything's kind of going up, and they just decide they're going to be a trader, investor, just because they decided to. There is a huge lack of respect in my industry for the education piece. Think about this for a moment. I have a brother who is a police officer. There's a tremendous amount of training before they give you a badge and a gun, right? To give you the authority to do police work, a tremendous amount of training. I have a brother-in-law who's an ER physician, unspeakable amounts of training, before you do that. In anything that you would look at, higher end incomes, higher, more success, things like that. Even in the arts, the Beatles put in their 10,000 hours in the Outliers, right? But for some reason, people will all of a sudden say, well, I'm a real estate investor. I'm going to go flip houses. And when we go into investing with a disrespect for the education required to do it well, without mentors, without coaches, without teachers, think about that really carefully. There was a teacher in the police academy, a whole bunch of them, teachers. There was a teacher at the medical school, a whole bunch of them, teachers. In the residency, there was mentors, right? There's the patrol officer. You have your partner. One of them is a senior. One of them is a junior. So in all of these things, whether it's law school, there was a major educational piece with hours and hours and time and energy and money put into the learning of such a thing. And yet, when I see people invest, there's a total disrespect or a lack of appreciation for the benefits of really practicing first, studying first, whether it's athletics, sports, art, science, math, anything, investing. I think assuming that it is just something people choose to do without the training, preparation, and education, I'd put that number one on the list. When I see people blow up their account in stocks, or I see people blow up their life in real estate by debt, they're, next thing you know, they're declaring bankruptcy. It's because they got involved with things that were just above their educational pay grade.
That's a really good point. Now, speaking of things that mistakes that you've seen, the lack of respect for maybe education, mentors. What about systems? What's your take on people investing without systems?
We have 4 pillars of investing that we teach, and that is our investing system. It works with real estate, stocks, business, whatever. It is universal because balance sheets are universal, right? Buying and selling, stock charts, technical analysis is universal. It transcends language, culture. Every business in the world on planet Earth has income, expenses, asset, liabilities, statement of cash flows. And so these things are consistent. When you talk about mistakes in those systems, I would say the next one is and I'll just go with stocks for a minute because it's the stock cast, is position sizing. Now that's tougher to do with real estate. I remember Grant Cardone and Robert had a disagreement on Robert's show where Grant was like, yeah, do 100 unit project or a 300 unit project. And Robert's like, maybe try a duplex first, or maybe a 3-2 house first, right? Before you try to tackle a project. And Grant's like, oh no, and big disagreement. I side with Robert on that completely. So in stocks, that would be position size. So here's the thing. We know how to click and get paid. And so we can click a button, have money come right now. Like I could get online right now, and in 30 seconds, we'd have money. The idea is with those rewards, there are still risks that are taken on and need to be managed. And I would say in risk management, the number one mistake I see people make beyond education is position size, where they position size to reward rather than position size to risk, and not knowing. So the education piece is not knowing how to adjust and manage the risk. The systems piece is you should have a system that limits. So I'll give you an example. A casino has something called a table limit, and that is the size of a single position that can be taken on a table at one time. There's a reason the casino does that, because now they have a max loss. They have a maximum on what they can lose in one hand, and that preserves the system of odds, probabilities, statistical, mathematics that keeps the game in their favor. If they were to remove the table limit, they'd be out of business, people would martingale until they won. It would just be tragic. So just as you go to the casino, there's always a bet limit, a table limit. There's a maximum that risk that the casino will allow themselves to take in one hand. The same is true with positions. Very, very important to have a position size that is, especially for traders. Now, with investors, those positions can grow over time and you can take a little bit bigger positions. But as traders, man, your position size is huge. So a good example, without getting too much jargon, would be iron condors, right? You have a high probability trade, a high risk trade, a moderate to low reward trade. So if of those three balls that you juggle in the air of probability, risk, and reward, if the reward is the smallest one, you should pay attention that the risk is the biggest one. And so you should position size to that risk rather than to the reward. So that's a mistake. Why does it happen? Well, someone says, I want to get out of the rat race, and they line up all their bills and say, I want to pay my house payment for my trading. So I'm going to make trades, click and get paid that fit my house payment on reward. Well, the risk on the other side of that becomes massive. And so position sizing in the system is a real important one, especially for option traders. That's a mistake. I see people blow up there. It is very hard to blow up an account if you have a system that has rules for position size. Perhaps 1% of the account is at risk in one trade. That's a good rule to have.
And I want to take that a little bit further because I think a lot of times entrepreneurs were very glasses is half full. We're very optimistic. I'm going to make all this money.
Tally Sharrett, optimism biance, right? Yeah, Tally Sharrett wrote a book on it. Yep.
And I know I'm guilty of that. I'd like to be an optimistic person, but what else? Speaking of risk management, what else should someone be asking themselves before entering a trade?
So here's another real big mistake that people make. Warren Buffett did not declare himself the Oracle of Omaha. He did not declare himself. That is not a self label. Other people gave him that label. I don't even know if he likes that label. I would say another common mistake is people approach the market as predictors as opposed to taking a different P word, which is prep. So let me give you an example. What I teach my students is there's 5 market directions, not 3. Most people think there's up, down, and sideways, right? Those are only 3. Well, there's 5. There's up a lot, which would be above a standard deviation. There's up a little, that's within a standard deviation. There's sideways, that's within a standard deviation. There's down a little within the standard deviation. Then there's down a lot outside of the standard deviation. So you really have 5 areas you can look at. What a mistake would be is to try to pick one of those 5 and bet on it. That's a mistake, because the defining characteristic of life is unpredictability. It's Forrest Gump. It's a box of chocolates, and you do not know what you are going to get. That is true. It kills me when people interview, the commander-in-chief or any of the generals. Well, how long is the war going to last? How in the HE double toothpicks could you possibly know how long something's going to last, right? You don't know. War is unpredictable. Well, the markets that could be argued as their defining characteristic, that we don't know tomorrow if the S&P is going up or down. We just don't know. So it's a massive mistake to base your system on prediction if unpredictability is the defining characteristic of the market. Just let that sink in for a minute. If unpredictability is a characteristic of the market, perhaps its most defining characteristic, to simply say, yeah, I'm going to be a predictor in an environment that's unpredictable, tell me that's not a recipe for complete failure. I mean, it's like I'm going to go into a situation that is always going to be unpredictable, and my approach to it is to predict it, to do something impossible. That's crazy. So a better way to correct that mistake is to look at those 5 possibilities and understand that is the domain and range. I mean, that's it. That covers the entire domain and range of the stock. It's 5 areas in any given amount of time. And so what we do is we prepare for all 5. Now, what that does is gives the illusion of prediction, gives the illusion because you were prepared for all of them. And that's why Buffett looks like the Oracle of Omaha, because if you're prepared for all 5, when does it look like that you were, not be able to see? In hindsight, I'll give you an example. Mark Cuban sells broadcast.com to Yahoo for 5.7 billion in shares. So now he's got 5.7 billion stock shares. He takes every dime that he has, millions of dollars, every dime he has, because he has a vesting period before he can sell those shares. So he puts all his money out there to insure it. He buys puts and he loses all that money. Now, no one knows that story. He lost hundreds of millions of dollars. And people say, well, he must be an idiot, because why would you just waste hundreds of millions of dollars? Well, because he didn't know whether it was going to go up or down. Now, after the vesting period was over and he spent all his money on insurance and lost it, now he had the ability to sell the Yahoo. So what he did is he sold calls and brought in hundreds of millions of dollars. And he turned around and took that and he bought puts to insure himself for hundreds of millions of dollars. Again, this time the market did fall. The dot-com bubble burst this time. Yahoo stock goes from $100 to like 5 or 8. And those puts become worth an absolute fortune. And it makes him look like he saw the bubble coming. It's a lot like saying, oh my gosh, you people in California, you were so brilliant to have bought fire insurance. You just knew that your house was going to burn down. And look at you. You knew that so well. No, you weren't predicting a fire. You were preparing for a fire. So it made you look like $1 million because it worked out, because you prepared for both. You prepared for the house to appreciate without a fire, and you prepared for a house to depreciate with a fire. So you had prepared for both scenarios. So I would say a third mistake, beyond no education, beyond bad position size, would be taking a predictive approach rather than a preparatory approach to investing. So I see guys bet on black all the time, and they get dogmatic about it. Particularly, this is something very much to this might tie into another one, but another mistake is arrogance. To think dogmatically. For example, people start to become emotionally attached to their investments. This is why the sunk cost fallacy brings people down. We were watching a movie as a family, and it was really inappropriate. My sons are old enough to watch movies, right? They're not children. But we were watching a movie, and it was so distasteful that none of us really liked it. And one of us said, well, we paid for it. I guess we watch it. And my older son, Zach, said, that's sunk cost fallacy. That's like immediately he says, no, that's sunk cost fallacy. We don't need to watch this. The money's gone either way. So why have the loss of the money and a shitty experience in the movie, right? Right? Why have both? Just get the sunk cost. And, if it's a crappy movie, it's a crummy movie. So people with their Bitcoin or their crypto, and Bitcoin's not, it's more of a mainstream, but these extreme fringe cryptos, they get emotionally invested and they get dogmatic and emotional with it, where they start rooting for it with a religious fervor, almost a political fervor, a loyalty to it. It's an investment. And the truth of it is, there is no risk-free investments. There's none. And then, oh no, it's risk-free, because no, there are no risk-free investments. And if you get dogmatic about that and you start predicting, those kind of go together a little bit. That dogmatic religious fervor towards an investment or investment class can make you start predicting things that you shouldn't be predicting. You should prepare for a downside in every investment. The reason that people might I hate calling myself an expert. I write a Rich Dad expert letter once in a while, but I'm a student, and I hate the arrogance of being called an expert. But if I am an expert to any degree, I'll tell you why it is. It's because I can tell you the pitfalls of stock investing. I can tell you how dangerous it is. I can tell you how it can kick you in the face. This very episode is an example, right? Where I talk to other folks, they're like, there's no downside to my investment, right? This little NFT I've got here, this NFT is going to the moon. Nothing can stop it. It's risk-free. Baloney. If you're really an expert, you tell me the risks around the NFT. You tell me the risks around the crypto. You tell me the risks around the debt of the real estate. Just because I love debt doesn't mean I don't respect it and appreciate that a lot of people have gotten burned with that fire, and a lot of people have used it to light their way.
That's brilliant right there. But let's do this. Let's take a quick break here. Listeners, mistakes are inevitable, but catastrophe, it's avoidable, right? When we come back, Andy's going to explain how experienced investors turn mistakes into learning opportunities and build systems that protect them from repeating them. And don't forget, go to stockcastbonus.com, download your free resources. These tools help build structure and confidence. So stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad StockCast. Andy, let's talk solutions. If mistakes are inevitable, how do smart investors prevent those mistakes from becoming financial disasters?
The number one way, okay, you're going to have them. Okay, you're going to have them. So it's not eliminating mistakes; it's reducing them. Right? You're going to have them. But the number one way, by far, in my opinion, to reduce mistakes is to have a mentor. The book Rich Dad Poor Dad, you could argue, and you would have a very good argument, is a book about mentorship. It is about one person who looked up to another person and found in that person a mentor, a teacher, a guide that really illuminated a lot of things. And even when you make the mistakes, it's great to have that mentor by your side. Warren Buffett had Benjamin Graham. Robert Kiyosaki had Rich Dad. Donald Trump had Fred Trump. It is, my friend Phil Town had the wolf that he, keeps nameless in his book. And so there's always the mentor, and they are the people who are the sages that give that sage counsel, not advice, but counsel. There's a difference. And that is the number one way to reduce mistakes. If I have Corey Halliday, just think how lucky I am. Corey Halliday worked on he retired from Wall Street years ago, loved his time there as a Series 4 option principal. So he was the head of risk management of the firm, and he's got hundreds of traders on the floor, hundreds. And they all have their positions going, trying to make money for the firm. And he's looking at that aggregate risk and managing it. There's probably no one within the sound of our voice right now that if you have one, put it in the comments, right? Oh, here's my Series 4 option principal, and this is her name or his name, right? That uniqueness of having a mentor like that with 20 years of that type of experience, there's just never been anything he hasn't seen. So when I have a question or I have a new situation arise or even a problem arise, having that mentor is priceless. It's worth millions and millions and millions of dollars to people to have mentors. They don't realize the monetary value of mistake avoidance and profit potential. in simply having someone who has gone before. It's school that does it. You don't get to have a mentor in school because that'd be cheating. You have to do your own work, keep your eyes on your own paper. But I would disagree. You have to be ethical, so you can't go to school and cheat. But just imagine how it would have been in school if I could have gotten a mentor to stand by me while I take my test. How many mistakes would I have on the test if I take, a Nobel Prize winner physics and I have her by my side when I take the physics test? You'd score high points. You'd make very few mistakes that way. Well, guess what? Once you leave school and you get in the real world, you're allowed to have as many mentors as you want, but we haven't been conditioned. It's been eyes on your own paper, do your own work. Well, I'm in a trade right now that wasn't even my idea. It's a great trade. Of the five, I have five of the five directions. Four of them will be profitable, guaranteed in any of those four. The where there's a not guarantee is one of those five. And I have the adjustment pre-planned if that comes to fruition. That all came from, wasn't even my trading idea. But he said, hey, take a look at this, bang. So having a mentor, just picture and imagine that. If you're in real estate and you want to go out and get in there, having a mentor at your side is the close. You can't guarantee success, but that's as close as you can get. That's as close as you can possibly get. If you want to lose 20 pounds, hire Jillian Michaels or whoever, the late Richard Simmons, or who was it? Is that who it was?
Richard Simmons, the Jazzercise or whatever it was.
Whoever, the late, rest his soul. Go hire a trainer and a nutritionist and a chef. And so the chef is in charge of cooking the meal. The nutritionist is just in charge of designing the meal. And then you have a mentor that makes you lift those weights. It'd be really hard with those three mentors, teammates, teachers, counselors. It would be very difficult not to achieve that goal. Very difficult not to achieve that goal. You would have to abandon one of those three mentors in order not to achieve that goal, or just not show up, right? So mentors, if you want to stop making mistakes or limit them or reduce them, that would be my number one way to solve it.
And a quick follow-up to that, I've heard people say, mentors helps increase speed and safety. What's your take on that?
Oh, I couldn't disagree. I mean, the argument against it is people, you can hear them out there whining, and here's another huge mistake, is they say, well, I can't afford it. And that's a lie. And in the book, Rich Dad Poor Dad, there's a very important section in that book, very important, where the rich dad would not allow those words to be spoken because it was a mistake. Robert and Kim, when they got married, they had a rule that said, we're not going to say the word can't. And I have that rule with my kids. I'm happy to go out and, work with them in the gym and be their rebounder and help them work on their shot. And every once in a while, one of them will slip and say, God, I just can't make shots today. And as soon as they say that, I say, okay, well, then we're done. Because if you can't, there's no use in continuing. If it's not possible, then we're done. And they know that I don't allow that language. And I'll just walk right out of the gym and we'll try again tomorrow. Because if you can't, you can't. So how can I afford a mentor is the way to do it. How can I afford a coach? How can I afford a athletic trainer? How can I afford a nutritionist? And what you'll find is people don't spend money on what they can afford. They spend money on what they want. And there's, in our society, the bottom quartile of society right now are wearing Jordans. They're wearing them. They're wearing Jordans. And, they've got an iPhone, and, well, I have to have those things. Well, okay, that's your opinion. But you could also have a mentor. So what is it? Jordans or a mentor? What do you want? So there you go. That sounds very crass, and I don't say that without compassion, right? The whole reason I'm a teacher is to lift people. It is to not to put people down, is to elevate their financial well-being. That's our goal. That's our mission, to elevate these guys. And it's done by learning, and learning comes from mentors. So how can you afford it? Really important.
I I love that idea so much, and one of my biggest takeaways was how can I afford it? I remember earlier in my career, to go along with what you said, just from a personal testimony, I invested in a mentor. It cost a lot of money. It was a big investment, but I could directly contribute. I 10x'd my return from that mentor. It hurts at first, but the results there. And from that lesson, it reminded me I should know that lesson as I invest in mentors going
it's
forward.
funny when you say it hurts at first, it's kind of a funny thing because the very second you have your first meeting with a mentor, it's gone. It's glorious. You're like, I'm there. I got this. And the calmness and like when I have Noah Davidson or Brian Halliday or Corey Halliday, any of those guys, if I call Than Merrill or a Kenny McElroy or a Tom Wheelwright or a Kim Kiyosaki, any of them, there's a sense of peace and we're going to be fine the very second you're in their presence. So anyway, we're probably getting stuck too long on it, but if you do want to reduce mistakes, that is a very viable way to do it.
Very good. Final question here. If someone has already made mistakes, what should they do next? What's the smartest next step to rebuild confidence?
Well, I think maybe it was Winston Churchill, maybe I'm misquoting, but I just love never, never, never give up. I love it. I'm a big Jonathan Haidt fan. He wrote a book called The Coddling of the American Mind and the Happiness Advantage. He's got a new one out on social media and the evils of that. But I just love resilience. Life is a fight. And I used to think that someday I wouldn't have to fight anymore, right? You'd be done and, life is a utopia and you live in the, Garden of Eden or whatever. That's not true. Life is a fight. And so the key is not to get to the point where there's no more fights. There's always one. The key is to learn how to fight. Just learn how to fight. And resilience, here's a mistake people can make. Here's a mistake they can make. They can think that investing in entrepreneurship is about a recipe of money. It is not. It is a exercise in a pursuit of personal development, discipline, temperament, knowledge. Always be bigger than your money. That's a temperament, discipline, mindset issue. It's a personal development issue. Bernie Madoff was the head of the NASDAQ. I'm sure his financial situation was not that bad, but he couldn't remain bigger than the money. So it's always a fight. I've seen it happen. When you compound, here's a mistake. When you compound, you're going to experience at some point exponential growth. And it's tough because you're going along like this and going along, you see a little bit, and all of a sudden it just turns and it goes exponential. And you could track that in most really, really wealthy people. It wasn't linear. It kind of just boom, right? Well, this right here, if you're going to remain bigger than your money, right? If you're going to remain bigger than that money, when that thing turns and life gets really good financially, right? Really good, your personal growth and development has to exponentially increase to match that exponential growth of your wealth. And Madoff couldn't do it. And the people who run the scams couldn't do it. And you see people get into Ponzi schemes and other things because they start to lie. It's because they could not remain bigger than their money. That's a huge mistake. So I will just guarantee you that when a person sets out to be an investor / entrepreneur, to go on the BI, the BI side of the cash flow quadrant, whether they know it or not, they're engaging in an exercise of personal development. And if they don't see that, that is a mistake. That's a mistake.
That's a great way to end this. Andy, thank you so much for this. Has been such a brilliant podcast. I've really enjoyed this. Listener, every investor makes mistakes. The goal isn't perfection. The goal is progress. And when you learn from mistakes instead of repeating them, that's when real investing, that's where the skills really start to develop. And again, big thank you to Andy for taking time to share these lessons with us. If you want to build the knowledge and systems that help investors avoid costly mistakes, go to stockcastbonus.com right now. You'll find free tools and resources designed to help you invest smarter. And if you got value from this episode, make sure you like, subscribe, share it with someone that is learning this investing game. Listener, you're not here by accident. You're building something that most people won't. So stay smart, stay invested, and we'll see you next time.
Thanks, Dell.
This podcast is a presentation of Rich Dad Media Network.